Well, good morning. Jayendra Rana here. So let us take the topic today: climate-driven financial risks in India. Climate-driven financial risks in India. As the planet warms and extreme weather events becomes more frequent and intense, insurers are struggling to cover the resulting ballooning economic losses. The insurance sector saw net underwriting losses soar to more than $100 billion in 2023, a new record according to industry estimates. So insurers often respond to these climate-driven financial risks by withdrawing coverage from exposed markets, raising premiums, and existing risk-prone communities. So at the same time, as insurance rates increase, people forgo coverage. This not only leaves them vulnerable to climate perils, but also drives prices even higher as the number of people paying premiums and sharing risks shrinks. So this perfect storm makes it more difficult for people and these vulnerable communities to get insurance. This prevents from accessing key services such as mortgages, which encourages climate migration and drags down macroeconomic stability and growth. India in the age of global warming. India has seen unparalleled growth and development in recent decades, but risks losing ground due to heightened exposure to climate perils, including heat waves, floods, and earthquakes. So it has endured a scorching summer this year, with capital city Delhi experiencing the country's highest ever recorded temperature of 49.9 degrees Celsius, that is 121.8 Fahrenheit. This heat wave caused schools closure in several states, while local governments sent out heat alerts to warn people to stay aside. Even so, dozens of outdoor poll workers died while working during this year's election. The impact of extreme climate events in India touches on nearly every aspect of its economy and society. But it is more pronounced in particularly exposed sectors such as agriculture, which comprises 15% of India's GDP and employs around 40% of its population. 70% among its rural households. Between 2015 and 2021, India lost 33.9 million hectares of crops due to excess rains and an additional 35 million hectares due to drought. Now, several Indian sectors, including agriculture, suffered $159 billion in economic losses in 2021. So, due to lost working hours from extreme climate impacts, by 2030, India is projected to see a substantial 5.8% decline in working hours, equivalent to 34 million full-time jobs due to heat stress. So these numbers are only likely to increase as climate change continues. If, as expected, 45 million people are forced to migrate from their homes by 2050 as a result of climate change, this displacement would have cascading effects on local economies, for example, by reducing tax revenues. There are three ways India is building climate resilience. The impact of extreme weather falls disproportionately on the shoulders of low-income Indian communities. But the significant barrier in accessing adequate insurance described above have created a coverage gap. So to address this challenge, this country's government, agencies and business leaders are working on a number of effective sector-specific local and national strategies. These initiatives could be replicated to help vulnerable communities in other parts of the world. Here are three of the strategies for building climate resilience at scale that are being implemented in India today. One is digital insurance platform for farmers. India's Minister of Agriculture recently launched the Sandbox for Agriculture and Rural Security, Technology and Insurance. That is called SARTHI. Sandbox for Agriculture and Rural Security, Technology and Insurance. So to provide a comprehensive suite of insurance products for farmers in rural India. Now this user-friendly digital platform will simplify the process of farmers to view the purchase insurance, to view and purchase insurance, helping to decrease the coverage gap for the roughly 40% of India's population working in the agriculture sector. Such initiatives will be pivotal in helping farmers to become more resilient while also shielding them from volatility of climate change. Second one is innovative income replacement insurance for women. For the Women's Climate Shock Insurance and Livelihood Initiatives, that is also called as WCS, Women's Climate Shock Insurance and Livelihood Initiatives, recently established a first of its kind income replacement product. So female outdoor workers are not forced to work during extreme heat waves. During a record-breaking heat wave this year, the product paid out to more than 46,000 female outdoor workers, replacing the income they would have lost due to their inability to safely work amid extreme temperatures. The program includes an early warning system that provides guidance for specific communities. It also helps participants access the financial system by providing bank accounts so they can receive the money more quickly and directly. This product is already being introduced to other at-risk communities in India and beyond. And the third one is pioneering heat action plans. Because India was the first country in South Asia to create a heat action plan after an extreme heat wave in the city of Ahmedabad in 2010 resulted in a 43% increase in mortality compared with the same period in previous years. So the plan includes a system to alert residents when dangerous heat waves are expected and provide cooling centers. It also educates healthcare workers about how to recognize and treat heat-related illnesses. A study of the impact of this program has shown it saves around 1,190 lives per year. So this heat action plan was complemented by a statewide policy to paint or tile roofs in white to reflect sunlight and help cool building. Heat stop wards were also set up in the state's major hospitals, while a workshop run by India's National Disaster Management Authority helps local officials prepare for extreme heat. So insurers could work more closely with policymakers and government officials to use the industry's leading risk analytics, predictive tools and climate data to inform more heat action plans and direct capital towards high impact adaptation interventions. So collaboration on climate adaptation required now. By 2050, extreme weather events are projected to cost the global economy $38 trillion per year without adaptation strategies. This is why insurance industry leaders must work with policymakers and other key stakeholders to accelerate action to prevent the worst impact of climate perils. So the case for proactively addressing climate risk has never been more clear. A recent study shows that each dollar invested in climate resilience yields up to $13 in long-term cost saving, but 88% of the climate disaster funding is allocated after extreme weather events happen. Achieving sustainable and resilient growth will require a generation-defining commitment from public and private leaders to build climate resilience in vulnerable communities and economies around the world. So in 2024, the Reserve Bank of India released a draft framework for climate risk disclosure to help Indian banks recognize the importance of physical and transitional risk. The framework aims to increase transparency and accountability and to help financial institutions address climate-related risk proactively. It also aims to incorporate climate-related issues into the policies, operations, and organizational culture of financial sector entities. Say, some ways that India's financial sector is preparing for climate change are mandating transition plan disclosure. This could help market participants evaluate businesses and allocate capital towards those that are more climate resilient. Then extending coverage to regional rural banks. This could help improve rural resilience, making Scope 3 reporting mandatory. This could provide more insights into supply chain emissions. So the climate change is already having an impact on India. With heavy rains and sweltering temperatures, so the RBI's actions are laying the foundation for a more climate resilient banking system, even though climate change might not seem like an immediate threat to bankers who typically provide short-term loans. So this is the current scenario of the climate change. This climate change scenario is continuing today because India, twice a year, the Reserve Bank of India reviews the stability of the country's financial system. Its latest report made for good headlines. The proportion of loans that have gone soar is a multi-layer low and likely to decline further. The Indian regulators have been slow to respond. It was not until earlier this year that the RBI finally released a draft framework that would require financial institutions to devise and disclose their strategies to mitigate climate-related risk. Even then, the timeline for adopting the new rules was exceedingly generous. For regular Indian banks, they will only fully come into force for the financial year that ends in March 2028. So what explains the lethargy? Part of the problem is no doubt the bureaucratic inertia that bedevils all policy making in India. Regulators are scared of stepping on each other's toes and on the governments. So Indian regulators may have been blissfully unaware that climate change posed macroeconomic risks. They no longer have that excuse. The very report that identified climate change as a major problem also listed in exhaustive detail how other central banks and regulators are responding. The roadmap is there. India just need to pick up the pace. Thank you very much.